Welcome to The Explainer. Today, we're basically becoming financial detectives. We're going to grab our magnifying glasses and investigate a pretty big corporate mystery. How in the world do auditors prove that the cash a company says it has is actually real? It's a high-stakes game of following the money, and you'd be surprised at the clues they have to uncover.
I mean, really think about that. A company's financial statement might say it has, say, $1 million in cash. But how do you know that? How do you prove it's not just a number somebody typed into a spreadsheet, that it's actual, real, spendable money? This is the fundamental question every single auditor has to answer.
So, our investigation has to start with a clear mission. Before any auditor can even think about following the money, they need a map of the territory. They need to know what they're looking for. And that mission really breaks down into these 4 key objectives. First, does the cash actually exist? Is it real? Second, does it truly belong to the company or is it someone else's? Third, is the amount recorded with 100% accuracy? And finally, is it all presented correctly on the books? You see, it's not enough for the money to just be there. It has to check all 4 of these boxes. This is what we'll call the initial recon phase. Like any good detective showing up to a crime scene, the auditor starts by just looking around. Are we talking about physical cash in a register? Or is it money spread out over a bunch of different bank accounts? Who's in charge of it? Who has the keys? What are the company's rules for handling cash? And this one's a big one. Is any of this cash tied up so the company can't actually use it? Getting the lay of the land is absolutely the first step. Okay, so now that our auditor has a map of the territory, it's time to check the company's security system. We're talking about its internal controls, basically the defenses it has in place to protect its own money. Put simply, internal controls are just all the rules and procedures a company uses to keep its cash safe. You could think of them as the alarm system, the locks on the doors, and the security guards that are there to protect the money from simple mistakes, or in a worst-case scenario, from outright theft. And this right here illustrates one of the most critical controls of all, segregation of duties. In a really strong system, the person who physically handles the cash is a different person from the one who records the transactions in the accounting books. Why is that so important? Well, think about it. If one person does both jobs, it's way too easy to just take some cash and then change the records to cover your tracks. Separating those tasks creates a natural check and balance. So it follows that if an auditor finds that the company's defenses are weak, let's say that cashier is also the accountant. That's a huge red flag. It means they just can't trust the system. And that means they have to do a lot more work themselves. They can't rely on the company's day-to-day processes, so they have to dig much, much deeper with a more detailed investigation. And that brings us to the heart of the investigation. The fancy term is substantive procedures, but really, it's just the point where the auditor stops looking at the system and starts gathering cold, hard evidence about the cash itself. Time to follow the trail. The first stop on that trail is the cash on hand. We're talking about the physical dollar bills and coins the company keeps in its cash registers or in a petty cash box. And really, there's only one way to verify it. You gotta physically count it. So let's imagine a scenario. The company's accounting records, what they call the books, claim there should be exactly 10,000 Egyptian pounds in the cash box. That's our starting number. But when our auditor shows up and does a surprise cash count, they only find 9,800 pounds. Uh-oh, the numbers don't add up. And just like that, we've got a lead. This 200-pound difference isn't something the auditor just shrugs off. No way. It's a clue. And now the auditor has to figure out why this money is missing. Was it a simple clerical error, or is it a sign of something much more serious? All right, next up, the auditor has to investigate the cash in the bank, which, let's be honest, is usually where the bulk of a company's money lives. This is a neat 3-step process. First, they get a confirmation sent directly from the bank to them. They bypass the company entirely. Second, they'll review the company's official bank statements. And third, they'll redo all the math that connects the company's books to what the bank says. It's all about cross-referencing with an independent source. Now, this is my favorite part. This is where all the clues start to come together. The auditor has counted the physical cash, they've confirmed the bank balances, and now they get to solve the puzzle of why the numbers might not line up perfectly right away. And the number one tool for solving this puzzle is the bank reconciliation. You can think of it like the Rosetta Stone that translates what the company thinks it has into what the bank knows it has. It's the document that builds a bridge between those 2 different sets of records. Okay, let's walk through this. The bank statement says the company has 248,500 pounds, but the company's own books say they have 250,000. So what gives? Well, it's all about timing. See, the company made a deposit of 6,500 pounds that the bank just hasn't processed yet. That's a deposit in transit. At the same time, they wrote a check for $5,000 that the other person hasn't cashed yet. That's an outstanding check. Once you account for those two timing differences, boom, both balances match perfectly at 250,000. Mystery solved. Now here's another really important clue an auditor is always on the lookout for, something called restricted cash. This is money that the company technically owns, but they can't actually spend it freely. Maybe it's being held as a guarantee for a loan or a big construction project. It's absolutely crucial to identify this, because even though it's on the books, it's not available for paying salaries or buying inventory.
So finally, after all the counting, all the confirming, and all the reconciling, the auditor has to present their findings. The investigation is done, and it's time to write up the final report.
And this is what that looks like in the real world. This is a note from an actual financial statement. It clearly states what makes up the cash number. But just as important, it specifically calls out that 100,000 pounds of that cash is restricted and has to be disclosed separately. This is the kind of transparency an audit brings to the table. The final report is a lot more than just a summary of the numbers. The auditor documents every little discrepancy. They communicate those weak controls, like, hey, that cashier shouldn't also be doing the accounting, directly to the company's management. And they recommend concrete ways to fix the system, like telling them to do these bank reconciliations every single month without fail. So when you look at the whole thing, from that initial recon to the final report, the entire process is designed to do one thing: provide trust. It gives investors, banks, and owners the confidence that the cash balance they see on a piece of paper isn't just a made-up number. It's real. And that assurance is everything, because people make huge decisions, worth millions or even billions, based on knowing those numbers are legit. And that brings our little investigation to a close. But I'll leave you with this to chew on. If you were the financial detective, what's the one weakness in a company's cash security system that would keep you up at night? Something to think about. Thanks for joining us on The Explainer.